Okay, so I spent my entire lunch break with a calculator and a spreadsheet, and now I'm kind of annoyed at a number I used to think was good news. Welcome to episode 38 of the Joinprop podcast. I'm Ken, and that's Jessica.
I can completely hear the frustration in your voice, and honestly, you have every right to be annoyed.
Yeah, it really feels that way.
Right, because what you're experiencing is practically a rite of passage in the retail trading industry. You spend years honing your edge, fighting the markets, and chasing these massive, flashy payout percentages.
Oh, the percentages are everywhere.
Exactly. Only to finally lift the hood on your proprietary trading account and realize the entire engine is fueled by your own hidden fees.
It's just wild.
But that frustration is exactly the fuel for our mission today. We are diving deep into this really comprehensive new guide from the Joinprop content team. It was just updated for July 2026, and it's titled Prop Trading Profit Splits, 80-95% Models Compared.
Which is such a crucial topic.
It is. Our singular goal for this deep dive is to shatter what the research team calls the profit split illusion. We are going to teach you, the listener, the exact mechanics of calculating your true take-home pay.
Yes, please.
By the time we wrap up, you are going to have this massive aha moment that will, fundamentally change how you evaluate prop firm funding forever.
I am absolutely ready for that moment because honestly, the sheer amount of time I've wasted staring at these slick marketing banners, just trusting the big bold font.
We all do it.
It's embarrassing. I felt like I was being so financially literate by hunting for the highest percentage, but I was actually just like walking right into a trap. And when we originally started mapping out episode 38 earlier this week, we had a completely different topic on the board.
We did, yeah. The charting software thing.
Right. We were going to do a whole breakdown on charting software optimization. But then this Joinprop research dropped into our laps, and I took one look at the math and realized we had to pivot immediately.
Yeah, the numbers here are just too urgent to ignore once you start mapping them out in the real world.
Exactly.
Because this financial drain is happening to traders right now, today, without them even realizing it.
So where do we start?
Well, the foundational concept we have to establish is this. A higher advertised profit split, say like a 90% or even a 95% split, does not automatically equal more money in your bank account at the end of the month.
Which sounds crazy.
Right. In many cases, it means the exact opposite. Now, to a rational person, that feels completely counterintuitive. 90 is a bigger number than 80. End of story, right?
That's basic math.
Yeah. But you have to step back and look at the mechanics of how these proprietary trading firms actually operate. They are not charities.
Definitely.
They are highly sophisticated risk management businesses. If a firm is offering you an aggressively massive piece of the pie on the front end, the underlying mathematics dictate that they must claw back their operational margins somewhere else on the back end.
You got to get paid.
Exactly. And they accomplish this through a highly structured taxonomy of hidden costs. We are talking about challenge fees, non-refundable activation fees, monthly platform subscriptions, and these highly restrictive withdrawal terms that honestly border on predatory.
This feels exactly like booking one of those ultra-budget airline tickets.
Oh, that's a good comparison.
Right, like you're sitting at your laptop, you see a banner ad shouting, "Fly across the country for $19.
And you think you beat the system.
Exactly. Your brain lights up, you click book, and you feel like a genius who just hacked the whole travel industry. But then you get to the airport.
Yep, here come the fees.
They hit you with a $50 fee just to bring carry-on bag. Then you find out it costs $20 to choose a seat so you aren't, like, wedged against the lavatory. You want a bottle of water, $10.
It adds up so fast.
By the time you land, that $19 flight actually drained more out of your wallet than if you had just bought a premium ticket on a legacy carrier that included your bags and your seat up front.
You're touching on a great parallel there, but the airline analogy actually falls short in one crucial, somewhat sinister way.
Wait, really? How so?
Well, an airline, despite all its annoying fees, actually wants you to reach your destination.
Right.
They need you to get off the plane so they can board the next group. A prop firm running a 95% split model. Depending on how they manage their risk, they might statistically prefer you crash before you ever withdraw a dime.
Wow. Okay, that is dark.
It's the reality of the business model for some of them. But let's stick with the baggage fees concept and break down the hidden cost taxonomy identified in the Joinprop sources, because the data is staggering once you actually categorize it.
Let's do it. Where is the first place traders are bleeding capital without realizing it?
It starts right at the gate with challenge fees.
Okay.
These are the upfront evaluation costs you pay just to prove you can trade. And according to industry data cited from Mevec's book, these fees can range from a nominal $15 to, well, over $1,000, depending on the firm and the size of the account you're trying to unlock.
$1,000 just to take a test.
Exactly. But here is the critical detail that most traders gloss over: the distinction between a refundable and a non-refundable fee.
Oh, right.
A $500 fee that is fully refunded upon your first successful payout is fundamentally just a temporary security deposit.
Yeah, you get it back.
But a $250 fee that the firm keeps forever, regardless of your success, that alters your entire profitability baseline.
Because a non-refundable fee is just a pure sunk cost.
Exactly.
Like, if I pay $250 non-refundable to get a funded account and I make $1,000 my first month, I didn't actually make $1,000.
No.
I have to subtract the $250 right off the top just to calculate my true net profit. I'm literally starting in a hole before I even take my first trade.
And that hole gets deeper when we move to the second category, which is monthly platform costs.
Those subscriptions.
Research from AquaFutures shows an incredible variance here. I mean, some firms charge absolutely nothing, $0 a month.
Which is what you want.
Right. But others charge upwards of $360 every single month just to keep your account active.
$360 a month? That's insane.
And the industry uses incredibly official-sounding technical jargon to justify these recurring charges. They will tell you it's for institutional level 2 data feeds or CME market access or server routing maintenance.
Which is a brilliant psychological trick, honestly.
It really is.
If I'm a retail trader sitting in my home office and I'm paying for an institutional data feed, I feel like a Wall Street professional. I feel like I'm paying for a premium edge. It totally strokes the ego.
It is masterful marketing. But let's look at the reality of market microstructure. Yes, raw data feeds from exchanges like the CME or Eurex cost money, but large prop firms buy enterprise licenses.
So you get a massive discount.
Huge. The per-user cost to the firm is fractions of a penny. When they charge you $150 a month for that connection, they aren't passing along a cost. They are monetizing your access.
Wow.
It is a pure subscription model designed to eat into your margins, regardless of whether you win or lose your trades that month.
It's just a guaranteed revenue stream for the firm, acting as a tax on the trader's performance.
Precisely.
Okay, so we have sunk cost challenge fees and we have recurring subscription taxes. What's the third piece of the taxonomy?
The final and often most painful piece involves withdrawal restrictions.
Getting your actual money.
Right. CoinCodeCap highlighted some incredibly frustrating pain points that traders experience right at the finish line. We're talking about flat processing fees per transaction.
Like wire fees.
Yeah. Imagine you have a smaller funded account, say a $10,000 account. You have a decent month, you make a $300 profit, and you want to withdraw it to pay your electric bill.
Sounds reasonable.
The firm charges a flat $30 crypto gas fee or a wire transfer processing fee.
Wow. So an instant 10% of your earnings is just vaporized by a processing fee.
Vaporized. And that's if they even let you withdraw it at all.
Wait, what do you mean?
Many firms impose minimum withdrawal thresholds. They might say, you cannot request a payout unless you have accrued at least $500 or $1,000 in profit.
So if you're a lower volume trader.
Exactly. If you are a slow, steady trader making $200 a month, your capital is essentially trapped in their ecosystem for a quarter of the year before you can even touch it.
That is so frustrating.
When you combine non-refundable entry fees, monthly subscription taxes, and withdrawal blockades, you really start to see the architecture of the trap.
So for a trader listening to this right now, they're staring at a spreadsheet of 5 different firms with 5 different percentage splits and a chaotic mess of fees. How do we cut through the noise? How do we find the actual signal?
This brings us to the central anchoring concept of this entire deep dive. It's the concept of the effective profit split versus the advertised profit split.
Okay, effective versus advertised.
If you are taking notes, this is the equation that will protect your capital. Your effective profit split is calculated by taking your total gross profit, multiplying it by the firm's advertised percentage.
Okay, got that.
Then subtracting all of your monthly fees and challenge costs, and finally dividing that entire net number by your original gross profit.
Okay, I understand the variables, but Hearing math spoken aloud always makes my eyes glaze over a bit.
Fair enough.
I need to see this tangible. Like, I want to feel how this actually plays out for a trader living through the ups and downs of a real market. Let's run a timeline.
A timeline is perfect.
Yeah, I want to stress test this formula over, say, a 6-month trading block.
We have to run a timeline because the 6-month earnings scenario detailed in the Joinprop guide is the absolute centerpiece of their research.
Okay.
This is where the marketing illusion shatters upon impact with mathematical reality. So we are going to meticulously walk through a very realistic half-year trading block. We are going to assume our hypothetical trader is highly competent but human.
Right, a real person.
They have an edge, but they also have fluctuating months because that is the reality of the market.
Exactly. Nobody just prints exactly $5,000 on the first of the month like a factory worker clocking in.
Right.
You have volatility, you have drawdowns, you have months where the market just doesn't align with your strategy at all.
Exactly. So let's map the gross profits for this trader over 6 months. In month 1, they generate a modest $3,000.
Okay.
In month 2, they find their stride and pull in $7,000. Month 3 is a massive breakout month. They make $10,000.
Nice.
But month 4 is choppy. They give some back and only net $5,000. Month 5 climbs back to $8,000. And month 6 is a stellar trend-following month where they close out with $12,000.
Solid half year.
Mhm.
Let me add that up. So our trader has generated a total gross profit of $45,000 over 6 months.
Correct, $45,000 gross. Now, we are going to drop this identical performance into 3 different prop firm models and see what the trader actually gets to put in their bank account.
Let's lay out the combatants.
Competitor number 1 is Firm A. This firm offers the traditional baseline 80% split.
Okay.
They charge $0 in monthly fees. Their initial challenge fee is $250, but it is fully refundable upon your first successful payout.
Okay, so Firm A is kind of the vanilla option.
Competitor number 2 is Firm B. They try to entice you by stepping the split up to 90%.
Ooh, 90%.
But to get that 90%, you have to pay a $150 monthly platform fee, and their entry challenge fee is $500, non-refundable.
Ah, okay, that's the premium bait.
And finally, we have Firm C, the holy grail, the 95% split.
The dream.
But they charge a heavy $250 every single month for their quote-unquote elite data package, a $750 non-refundable challenge fee, and they enforce a strict 20% profit buffer requirement before you are allowed to withdraw anything.
All right, let's run the tape on Firm A. The trader made 45,000 Chroma gross.
With Firm A, the math is refreshingly clean. You take 80% of $45,000, which gives the trader $36,000.
36 grand.
The $250 challenge fee is refunded after that first $3,000 month. There are no monthly subscription taxes bleeding the account.
So it's just pure profit.
Yep. So the trader's real take-home pay is exactly $36,000. Their effective profit split perfectly matches their advertised profit split 80%.
It's transparent. What you see is what you get. But I'm looking at Firm B, and my human brain is still screaming that 90% has to be better. Walk me through Firm B.
Let's look at the illusion. Firm B advertises 90%. So 90% of your $45,000 gross is $40,500.
Okay, wait. On the surface, looking just at the gross payout, you are $4,500 ahead of Firm A.
Yes, and this is the exact moment most traders stop doing math and sign the contract.
I mean, I would.
But we have to factor in the taxonomy of costs. You have a $150 monthly fee. Over our 6-month timeline, that compounds to $900 out of pocket.
Ouch.
You also have that $500 non-refundable sunk cost challenge fee. When you subtract that $1,400 in total operational costs from your $40,500 payout.
Let me do that math. Your real take-home pay drops to $39,100.
Exactly.
Okay, wait. I'm tracking the math. But $39,100 is still objectively higher than the $36,000 from Firm A.
It is.
So in this specific 6-month scenario, the 90% firm actually did pay out more, despite the fees.
That's true. In this specific, highly successful scenario, Firm B yields slightly more absolute dollars. But look at what happened to the margins.
Right.
You took on significantly more upfront risk with a larger non-refundable fee. You took on the psychological stress of a recurring monthly bill. And your 90% advertised split was quietly reduced to an 86.8% effective split.
You lost 3% of the house.
No.
Exactly. But the real devastation happens when we look at Firm C.
The 95% model. The siren song. Let's run it.
Okay, 95% of $45,000 is an incredibly attractive $42,750.
Wow.
But then the firm's accounting department steps in. You subtract $1,500 for 6 months of their $250 monthly fee.
Man, that's steep.
Then you subtract the $750 non-refundable challenge fee. Instantly, your take-home is down to $40,500.
Which is barely higher than Firm B, despite the full 5% jump in the split.
But the math doesn't end there because Firm C weaponizes liquidity.
Weaponizes liquidity,
Yeah.
right, the buffer.
Yes, they have a 20% profit buffer. This means if you are trading a $100,000 account, the firm requires you to leave $20,000 of your profits sitting in the account as a cushion to protect them from future drawdowns.
So you can't touch it.
You generated $45,000 in profit over 6 months, but a massive chunk of that is legally untouchable. You can't withdraw it, you can't invest it elsewhere, you can't use it to pay your mortgage.
That's insane.
Depending on how that buffer is calculated, your actual liquid take-home pay over those 6 months might be drastically lower than Firm A's clean $36,000, simply because Firm C won't let the money leave their servers.
Hold on, I see a flaw in this logic.
Okay, lay it on me.
We are talking about a trader making $45,000 over 6 months. But what if I am absolutely crushing it?
Define crushing it.
Let's say I'm a rock star algorithmic trader pulling down $100 grand every single month. If I have a $100,000 profit month, a fixed $150 monthly platform fee is literal pocket change.
Sure.
It's completely irrelevant compared to the extra 10% I'm getting from a 90% split. I mean, 10% of 100 grand is an extra $10,000. I will gladly pay a $150 fee to make an extra $10,000. Doesn't this formula completely break down for top-tier earners?
Your logic is entirely sound, but only for a microscopic fraction of the market.
Okay, fair.
If you are in the absolute top 1% of retail traders, consistently clearing 6 figures a month without fail, then yes, the fixed monthly fees become statistically negligible. You should absolutely take the highest percentage split you can find, assuming they actually process your payouts.
Right.
But, and this is a catastrophic, but for the rest of the industry, that scenario is a statistical anomaly. The proprietary trading firms employ brilliant actuaries. They know that consistent 6-figure retail traders are unicorns.
They don't really exist in large numbers.
No, they don't. They build their entire business models around the vast, vast majority of traders who reside in the middle class of profitability.
People who are consistently profitable but have, like, normal human volatility.
Precisely. Let's look at a much more realistic, yet still highly commendable scenario. Let's say you are a swing trader who earns $60,000 in gross profit over a 12-month year. That is a fantastic supplemental income. It requires immense skill and discipline to pull $60K out of the market.
Absolutely. That's a solid average of $5 grand a month. Anyone listening would be thrilled to add that to their annual income.
Right. Now, drop that trader into a firm with a $150 monthly fee. Over 12 months, that fee totals $1,800. For a $60,000 annual earner, that single $1,800 fee instantly reduces your total earnings by a full 3%.
Wow.
So your advertised 90% split is immediately knocked down to an 87% effective split. But let's look at the micro level, the month-to-month reality.
Okay.
Remember our premise. Traders have fluctuating months. Let's say in November, the market is incredibly choppy, your setups aren't triggering, and you only manage to grind out $500 in profit.
Which is still a green month. In trading, surviving a choppy month and walking away green is a victory.
It is a victory until you realize you still owe the prop firm $150 for the platform fee.
Oh, man.
That flat fee just devoured 30% of your earnings for that 30-day period.
30%.
You took 100% of the mental stress of navigating a choppy market, and the firm took 30% of your meager profits just for the privilege of leaving the terminal open.
That hurts.
For the average consistently profitable retail trader, fixed recurring costs act as a massive drag coefficient on their long-term compound growth. It is a mathematical snare explicitly designed to slowly bleed the middle class of traders while allowing the firm to market itself with the success stories of the 1% unicorns.
That is incredibly sobering. When you frame it as a 30% tax on a slow month, the psychology of it totally shifts. I'd be furious.
Most people are when they realize it.
So, If we basically just proved mathematically that a clean, transparent 80% split can often outperform a murky, fee-laden 90% split for the average trader, it begs a massive question.
Which is?
Why is the prop firm industry segmented this way? Why are there all these different tiers of splits if 80% is the most sustainable model?
Because it's a brilliant execution of market segmentation. Firms know that traders have different psychological profiles, risk appetites, and levels of financial literacy. Let's explore the established landscape of the industry right now, starting with what we call the traditional 80% standard.
Okay.
There is a very specific reason why many of the oldest, most respected top-tier firms still proudly offer only 80%.
The sources mentioned a few specific heavy hitters in this category, right?
Yes. The Joinprop guide highlights firms like Atlas Funded. Atlas offers varying fee structures, but their entire brand reputation is built on immense reliability.
Right.
They aren't trying to dazzle you with 95%. They are promising that when you request your 80%, the check will actually clear.
Which is pretty important.
Then you have a firm like E8 Markets, which is an incredibly fascinating case study in operational infrastructure.
What's their edge?
They offer a sliding scale 80 to 100% split, but their true differentiator, the reason professionals use them, is their liquidity mechanics. They boast incredibly fast average payouts, clocking in at an average of just 29 hours.
Wait, 29 hours from clicking withdraw to the money hitting your account?
Yep.
That's barely more than a day. In this industry, that level of liquidity is practically unheard of.
It's a massive, tangible feature. Firms operating in the 80% standard often possess robust A-book infrastructure.
Let's talk about A-book for a second.
Yeah, they are likely passing your trades directly to live liquidity providers, meaning when you make a profit, the live market pays you, not the firm.
Oh, okay.
Because the firm isn't paying you out of their own pockets, they have absolutely no incentive to delay your payout. They take their clean 20% commission for providing the capital, and they send you your 80% immediately.
That makes total sense.
They offer transparent rules and operational speed. They are offering a sustainable business partnership, not a lottery ticket.
Okay, so that's the bedrock, the reliable 80%.
Yeah.
But obviously, human nature dictates that 80% won't satisfy everyone.
Exactly, which brings us to what the research categorizes as the 85-90% middle ground.
The middle ground.
These are firms that recognize a large segment of retail traders view 80% as too low. The firm wants a sexier headline number to acquire these customers, but the firm's risk management department still needs to protect the downside.
So they had to compromise somewhere.
So they engage in a balancing act of giving away higher percentages but tightening the operational rules.
Who are the players sitting in this middle ground?
The MQL5 data highlights firms like Funded Next. They actually offer up to 95%, but it requires purchasing a specific lifetime payout add-on, which is another upfront cost.
Always an add-on.
However, they allow scaling up to a massive $4 million capital allocation, appealing to traders who want massive leverage. Then you have Think Capital.
What's their deal?
They offer higher payouts, but they offset that risk by imposing much more stringent scaling rules, meaning it is significantly harder and takes much longer to grow your initial account size.
Gotcha.
And TopStep has a brilliant, highly unique psychological model. They operate via Phidias prop firm and offer you 100% of your profits on your first $10,000 in cumulative payouts.
Wait, 100%. They take nothing on the first 10 grand.
Nothing. It's a loss leader designed to get you hooked on their platform and prove their reliability. Once you cross that $10,000 threshold, the split drops to a traditional 90-10 model for the rest of your career with them.
Here is what genuinely fascinates me about this middle ground from a purely behavioral economic standpoint.
Yeah.
Why does the human brain latch so tightly onto that 90% visual while completely ignoring a phrase like stringent scaling rules? I mean, I am highly guilty of this myself.
We all are.
I'll read a firm's homepage, I see the giant 90%, and my brain just releases a hit of dopamine and shouts, more money. I don't even bother scrolling down to read the scaling terms.
It's a textbook example of cognitive anchoring bias.
Anchoring bias.
The human brain is incredibly lazy when evaluating complex systems. We anchor to the primary, most easily digestible metric presented to us. The 90% is displayed in a huge, bold, gold leaf font on the homepage hero image. The stringent scaling rules, or the trailing drawdown mechanics, are buried on page 14 of a PDF rulebook that you have to navigate through 3 submenus to download.
It's by design.
But if we pull back the curtain, it all comes down to the core mechanic of proprietary trading.
Which is who holds the risk.
Exactly. The firm is providing the capital. If you blow the account, the firm takes the loss. If they are agreeing to give you 90% of the upside on their capital, the math demands they manage their downside risk.
Right. There is no free lunch in institutional finance.
None. They manage this risk by making it statistically harder for you to access that capital, by limiting the velocity at which you can grow the account, or by charging heavy, non-refundable evaluation fees up front to build a treasury that covers the losses of failed traders.
This is not a gift.
When you see 90%, you aren't seeing a gift. You are seeing a highly calibrated risk transfer mechanism.
Okay, so if the 90% middle ground requires all these calculated trade-offs and hidden balancing acts, what on earth happens when a firm pushes the model to the absolute breaking point? What happens when you step into the 95% arena?
Welcome to what the Joinprop sources ominously call maximum payout territory.
Sounds intense.
This is the ultimate marketing bait. It preys on pure greed.
This is the $19 airline ticket where they charge you for the oxygen mask.
It is, but as we noted earlier with a darker twist, discussing these 95% splits requires us to look at how firms weaponize their fine print. A report from Milo magazine specifically noted that these ultra-high split environments almost always come paired with higher account minimums, notoriously slow scaling plans, and highly restrictive withdrawal policies.
Can you give an example?
Take Apex Trader Funding as an illustrative example cited from the Phidias prop firm data. They offer a staggering 100% on your first $25,000 in payouts and then shift to a 90-10 split.
That sounds amazing on paper.
But to operate in these high payout environments, you have to navigate a minefield of rules.
Let's drill down into that phrase from the outline, withdrawal weaponization, because that sounds incredibly aggressive.
It is.
What does it actually mean in practice on a random Tuesday morning to have a payout frequency limit or a profit buffer? How does that actually stop me from getting my money?
It is the most effective tool they have. A payout frequency limit means the firm's rules stipulate you are only legally allowed to request a withdrawal once every 30 days, or in some extreme cases, once every 60 days.
2 months.
Yes. And a 20% profit buffer is even more severe. It means you must achieve a 20% return on your funded account, which, by the way, is a massive hedge fund level annual return that they're asking you to do in a month.
Right.
And you must leave that money sitting in the account before you are permitted to withdraw a single dollar above it.
Why? What is the actual structural mechanism behind firms doing this? Is it just administrative laziness, or are they just trying to be difficult?
It is highly strategic, and it often points to the firm operating a B-book model.
Okay, define B-book for the listener, because that's a crucial piece of industry jargon.
We touched on A-book earlier. In an A-book model, the live market pays you. But in a B-book model, the firm internalizes the risk. You are essentially trading in a highly sophisticated simulation.
Yeah.
When you buy gold, the firm is quietly taking the sell side of your trade. They are betting against you. Because statistically, over 90% of retail traders fail, the firm makes massive profits by simply pocketing the losses of failed traders.
Wow. So in a B-book, if I win, the firm literally have to pay me out of their own bank account.
Precisely. It is a direct conflict of interest. And that is why withdrawal weaponization exists. By enforcing a 30-day payout frequency limit or a 20% buffer, they keep the capital locked in their ecosystem for a longer period.
The longer it sits there.
The longer your unrealized profits sit in that simulated trading account, the higher the statistical probability that you, a human being prone to emotional errors, will hit a drawdown, over-leverage a trade, and lose those profits back to the market.
Which means you lose them back to the firm.
Before they ever have to cut you a check. It is a psychological game of chicken designed to delay the realization of your profits until you inevitably stumble.
But let's push back on this purely from the perspective of trader psychology. Let's say I am an incredibly disciplined, Zen-like, patient trader.
Okay.
Let's say I have a lucrative day job. I don't need trading income to pay my rent or buy groceries. Shouldn't I just take the 95% deal, accept the annoying buffer, accept the slow 60-day payout frequency, and just let my money sit there and compound over the course of a year? If I just wait them out, I get 95% of a massive number.
If the proprietary trading industry were as heavily regulated, audited, and FDIC insured as the traditional banking system, I might concede that point.
Right.
But it is entirely unregulated. The risk of leaving large amounts of capital sitting on the servers of a prop firm for 12 months is substantial and, frankly, reckless.
What's the main risk?
First, there is massive firm insolvency risk. Over the past few years, we have seen massive, seemingly bulletproof prop firms go out of business overnight due to regulatory crackdowns or internal mismanagement, taking millions in unrealized trader profits down with them.
Poof. Gone. No recourse.
None. Second, there is the risk of unexpected rule violations. You might patiently leave $20,000 in profits sitting in an account for 6 months.
Yeah.
Then, on a highly volatile news day, a spike in price triggers a hidden, deeply buried trailing drawdown rule that you miscalculated by a fraction of a percent.
Oh, man, I've seen that happen.
The firm instantly breaches your account for a rule violation,
Huh.
revokes your funding, and confiscates the entire $20,000 in unrealized profit. Restricted liquidity completely nullifies the entire benefit of being a funded trader. If you cannot touch the money, move the money, or spend the money, it is not money. It is just pixels on a screen.
Pixels on a screen. That is a terrifying way to frame it, but it's the absolute truth. You know, this whole conversation has made me realize a massive blind spot we've had so far.
What's that?
We have spent this entire deep dive obsessing over a 10% or 15% difference in the profit split percentage. But 90% of a $10,000 account is still pennies, compared to 80% of a $1 million account.
Exactly.
Which logically leads us to the other major variable, the Joinprop guide highlighted scaling plans.
This is perhaps the most important concept we will discuss today. Research from FX Empire calls a firm's scaling plan the secret multiplier.
Secret multiplier.
A scaling plan is simply the rule set dictating exactly how and when a firm will increase your capital allocation based on your consistent performance. It is a critical yet shockingly overlooked component of your lifetime earnings potential. Traders agonize over the initial split but ignore how the capital grows.
So how does this secret multiplier actually work in the real world? Give me the mechanics.
It is all about the mathematical miracle of compound capital. Let's look at specific empirical examples from the data. FTMO is the classic industry standard case study.
Yeah, okay, FTMO.
According to MQL5 data, FTMO's scaling plan doesn't just bump your profit split from 80% to 90% once you meet their consistency targets. They also increase your actual account-based capital by 25% every 4 months if you qualify.
So if I start with a $100,000 account, I'm getting 80%. I hit my targets, and 4 months later, I'm trading a $125,000 account, and I'm now getting 90% of the profits from that larger pool.
Exactly. It's a double compounding effect. You are getting a larger percentage of an aggressively expanding pie.
That's huge.
And then you look at accelerated scaling models, like Blue Guardian. They offer a highly aggressive path to a $400,000 account allocation.
$400K.
They do this by offering a 20% balance increase every 3 months, provided the trader hits a 10% profit target.
Okay, I want to scrap the old analogies and look at this like institutional finance. It's like comparing someone flipping a $50,000 cash house by themselves versus a real estate developer using $5 million in bank leverage to build a luxury apartment complex.
Oh, that's a perfect analogy.
Right. If you have a choice, you would much rather take a clean 80% cut of the massive apartment complex's revenue than fight tooth and nail to keep 100% of the tiny single house flip. The leverage is where the actual wealth is generated.
That is a brilliant way to conceptualize it. The leverage is the product. This is precisely what we mean by the hidden costs of slow scaling.
Slow scaling kills you.
If a firm boasts a shiny 95% split, but their scaling plan dictates that they refuse to increase your capital for 12 months, or they set the scaling profit targets so mathematically high that they are statistically improbable to hit without violating a drawdown rule, they are effectively choking your total lifetime take-home earnings.
Because you are permanently capped at your starting capital.
Yeah.
You can never build real wealth.
Right. Trading with a slightly lower split, say 80%, on a massively scaled, rapidly compounding account is vastly mathematically superior to a 95% split on an account that is artificially capped forever.
Wow.
When you evaluate a firm, you have to evaluate their velocity of capital, not just their payout percentage. Okay, my head is spinning a bit. We have all these abstract, heavy variables floating around the studio right now.
It's a lot to take in.
We've talked about A book versus B book, non-refundable challenge fees, platform subscription taxes, withdrawal buffers, trailing drawdowns, and scaling velocity. It's a massive cognitive load for a trader to hold in their head while also trying to analyze a chart.
It really is.
To bring this all down to earth, I want to look at a single, isolated month of success. The Joinprop guide provides a fantastic stress test, isolating a hypothetical $10,000 gross profit month. Let's walk the listener through this reality check.
Let's do it. We are going to break down the real take-home earnings table for a hypothetical $10,000 gross profit month across 6 different firm models. We need to verbalize this data step by step because this is where the theoretical math hits the pavement.
Okay, let's start.
Let's start with our baseline, Firm A. This represents the 80% split, low-fee model.
Lay out the parameters.
The advertised split is 80%. The initial challenge fee was $250, but it is fully refunded. The monthly platform fee is $0. There are no withdrawal restrictions or buffers.
Clean.
On a $10,000 profit month, 80% of that is $8,000. Because there are 0 deductions, the real liquid take-home pay that hits your bank account is exactly $8,000. The effective split is a perfectly clean 80%.
Solid. Transparent. Now let's look at another 80% model, but one with higher fees. The guide specifically mentions FTMO here.
Right, the 80% split, high-fee model. The advertised split is 80%. But for this calculation, let's factor in a non-refundable challenge fee equivalent of $155 and a 14-day administrative delay on withdrawals. There is 0 monthly fee.
Okay, so a small sunk cost.
Your $8,000 gross cut is reduced by subtracting that $155 sunk cost, bringing your real take-home to $7,845. Your effective split drops slightly to 78.45%.
Okay, moving up the percentage ladder, let's look at the 90% tier. Firm B, the moderate fee model.
Advertised at 90%. So your gross cut of the $10,000 profit is $9,000. But you have a $500 non-refundable challenge fee hanging over your head and a $150 monthly platform fee that just hit your credit card.
Subtracting the costs.
You subtract that $650 total in operational costs from your $9,000 cut. Your real take-home is $8,350.
Let me do that math. $8,350 on a $10,000 profit. Your effective split is 83.5%.
Exactly.
So you chase the 90% banner, but you're only effectively getting 83.5%.
Now let's look at Apex, which the sources categorize as the 90% premium fee model, advertised at 90%. Challenge fee is $150, non-refundable. The monthly fee is $150.
Okay.
But here is the structural kicker. They enforce a $500 minimum withdrawal rule and an 8-day payout wait.
Okay, but assuming you clear the minimum, which you easily do with a $10K a month.
Right, you subtract the $300 in total operational fees from your $9,000 gross cut. Your real take-home is $8,700. Effective split, 87%.
Finally, the big one. Firm C, the 95% restricted model. The $19 airline ticket.
Advertised 95%. Gross cut is a beautiful $9,500, but the challenge fee is $750, non-refundable. The monthly subscription fee is an agonizing $250.
Ouch.
And you have that weaponized 20% profit buffer. By subtracting just the $1,000 in immediate tangible fees, your $9,500 gross drops instantly to $8,500. Your effective split plummets from 95% down to 85%.
Wow.
And that is before we even factor in the liquidity trap of the 20% buffer, which means you might not even be able to withdraw that $8,500 for months.
Okay, let's pause right there. I want to make sure you listening are grasping the absolute absurdity of this. Firm C promised you the world. They offered a 95% split. But after their ecosystem of fees on a massive $10,000 profit month, the trader walks away with $8,500 in liquid cash.
That is correct.
And the Joinprop guide has their own internal top pick, which they categorize as the optimized balance model. Walk me through that.
The Joinprop top pick firm advertises an 85% split, but it features a $0 refundable challenge, absolutely 0 monthly platform fees, and fast, low minimum A-book withdrawals.
So 85% of $10,000 is $8,500 in gross profit, which means, wait.
You see it.
I do.
The real take-home pay for the 85% transparent firm is $8,500, yielding an effective 85% split. The real take-home pay for the 95% highly restricted firm is also $8,500, dropping its effective split to 85%.
That is mind-blowing. You took on all the headaches. You took on the massive risk of a higher non-refundable challenge fee. You carried the psychological stress of a $250 monthly subscription hanging over your head while you traded.
Yep.
And you navigated the liquidity trap of a 20% buffer, tying up your capital. You did all of that just to make the exact same amount of money as the person who took the clean, boring 85% deal.
That is the aha moment right there.
Yeah.
The profit split illusion is completely shattered when you lay the math out side by side. So what does this ultimately mean for the trader listening to this right now? How do they apply this heavily quantitative deep dive to their own subjective trading journey?
Right, because trading isn't a monolith. A guy trading algorithmic breakouts on the 1-minute chart has totally different needs than a woman swing trading daily Forex pairs.
Exactly, which means the best firm depends entirely on your specific trading style. It is a highly personalized calculation. If you are a high consistency trader, meaning your strategy generates frequent but small wins.
Like a scalper.
Yes. Let's say you're a scalper pulling a very consistent $500 to $1,000 out of the market every month. You absolutely require a firm with 0 monthly fees and a moderate 80 to 85% split.
Because of the fixed fees.
Because if you have a $150 fixed monthly fee and you only make $500, that fee is devouring an unsustainable percentage of your profit margins. Fixed fees destroy high consistency, low yield strategies.
Right. The recurring subscription model will bleed a scalper dry.
Yeah.
But what if your style is the exact opposite? What if you are a trend-following swing trader who might only have 3 or 4 winning months a year, but when you catch a trend, you win huge?
For traders who rely on infrequent but large wins, you actually might want to strategically maximize your earnings by hunting for those 90 to 95% splits.
Oh, really?
Yeah. If your strategy pulls down a massive $30,000 in a single month, paying a $250 monthly fee is practically a rounding error on your spreadsheet. You won't even notice it.
That makes sense.
However, and this is vital, you can only pursue this path if those ultra-high split firms do not trap you with withdrawal delays or buffers. If you make $30,000, but the firm's 20% buffer rule dictates you cannot touch $15,000 of it, the high split wasn't worth the paper it was printed on.
It is incredible how much mechanical nuance and risk management theory exists just beneath the surface of these shiny marketing banners.
It really is.
To briefly recap what we've unpacked today from the Joinprop content team's updated July 2026 guide, a higher advertised profit split does not guarantee more take-home pay. In fact, it often masks a predatory fee structure.
True.
The only metric that truly matters to your bottom line is the effective profit split. You have to take your gross profit, multiply it by the advertised percentage, subtract all monthly subscription fees and sunk cost challenge fees, and divide that net number by your gross profit.
That's the formula.
You have to run that equation before you sign any agreement, before you pay any evaluation fee, and before you take a single trade.
It is mandatory due diligence. Calculate the effective split, evaluate the hidden cost taxonomy, understand if they are A booking or B booking your trades based on their withdrawal rules, and meticulously factor in the velocity of their scaling plans. That is how you survive, protect your capital, and actually thrive in this ecosystem.
Now, before we sign off, I want to pose one final, slightly provocative thought for you, the listener, to mull over. Something that builds on the mechanics we've talked about today, but pushes it to its logical extreme in the future.
It's a fascinating thought experiment based on the current trajectory of the industry. Consider this. What if the future of the proprietary trading industry shifts away from profit splits entirely?
No splits at all.
Right. Imagine a new model where a firm launches and tells you keep 100% of your profits from day one. It sounds like absolute paradise, right? The ultimate trader's dream. But the structural catch is you are required to pay exorbitant, tiered monthly subscription fees just for the privilege of holding their capital. We are talking maybe $500 a month for access to a $50,000 account, or $1,000 a month for a $100,000 account.
Wow.
Keep all the profit, but pay a massive rent on the leverage. As a trader, how would you evaluate your personal statistical edge in a pure high-cost subscription model versus a traditional profit-sharing partnership?
That's tough.
Which model truly aligns the firm's success with your own? Because in a pure subscription model, the firm makes money whether you win, lose, or draw, as long as you keep paying the rent.
That is a brilliant question, and honestly, one I think every retail trader needs to ask themselves as this industry continues to rapidly evolve and invent new ways to monetize our ambitions. Keep dissecting the fine print, keep running your own mechanical numbers, and never, ever accept a headline percentage at face value. Thanks for joining us for this deep dive, and we'll catch you on the next one.